Bank of America just reported a massive 50% plunge in their earnings year over year, a concerning sign for the state of the U.S. banking sector as problems continue to crop up across the U.S. economy in 2024. With the Wall Street Journal reporting that Bank of America's profits fell by more than 50%, down to $3.14 billion on the quarter, down 56% from a year earlier. Now, according to Bank of America, this drop in earnings is largely because of one-time items. However, digging deeper into their report, you could see a big concern is that more loans are going bad, with the bank charging off $1.2 billion in loans, up 73% from a year earlier, which is a signal that more and more consumers are beginning to default on their debt, everyone. This is a big concern. We're seeing more and more stress build in the background. And historically speaking, everyone, these increases in debt charge-offs are a signal that problems are building in the economy and that a recession could be on the way. And of particular concern, everyone, is two different types of loans that Bank of America and many other banks are actually now struggling with, including JP Morgan. It's loans related to credit cards. You know, when people rack up credit card debt, the bank is loaning people the money and the people aren't paying them back, as well as loans on commercial real estate. Because in Bank of America's earnings release, they reported on the increase in both of these. And I want you guys to take a look at what's going on here, this concerning trend. It's these two graphs. The first is their consumer net charge-offs, which again is the amount of loans that Bank of America is basically saying, like, we're not going to collect on because the people aren't paying. You can see that surged from $531 billion in the fourth quarter of 2022 up to $913 billion in the fourth quarter of 2023. So that was about an 80% increase, what was largely defaults and charge-offs on credit cards, which is signaling more and more stress for American consumers. Now, at the same time, everyone, we're also seeing more commercial charge-offs and bad debt, particularly from commercial real estate. You can see a big surge in bad debt and loans that were written off in commercial real estate in the fourth quarter. And what concerns me is that I suspect both of these trends are going to continue into 2024, with more and more people struggling to pay off their credit card bills and more commercial real estate owners going into default and foreclosure on their properties. Just a couple weeks ago, I did a video for you guys on the commercial real estate crash. We're seeing office buildings around America collapse by 50% in value. We're seeing apartment buildings collapse by 25% in value. So we're just at the start of this wave of commercial real estate defaults. And as it builds more and more in 2024, there's going to be problems for the banks, because the banks are going to have to take increased losses on all of these bad loans, which are going to lower their income and lower their ability to make new loans into the economy, everyone, which is what's called a credit crunch, one that is already well underway, with the growth rate in loans at commercial banks declining all the way to 2.3% at the end of 2023. So you can see there's a heavy deceleration in banks issuing new loans over the last year. Yes, it's still positive growth, but this is actually one of the lowest rates that we've seen in a long time. As we go back through history, is that every time commercial bank lending tends to collapse or decelerate heavily, there is a recession, which is what these gray bars indicate. And so if you're someone tracking the economy right now, trying to understand where the unemployment rate's going to head, where home prices are going to head, where the stock market's going to head, this has got to be a concerning graph. We're already seeing the banks tighten the belt on lending, just as we're seeing more and more defaults from commercial real estate owners and consumers, is that this isn't just a Bank of America problem, everyone. We also had earnings reports from the other big banks last week, including JP Morgan, Citigroup, and Wells Fargo. And by and large, these earnings reports, they weren't very good, with CNBC reporting that big bank earnings point to a grim season. In particular, they talked about Bank of America's 50% decline in revenue. They also talked about JP Morgan, who had lower fourth quarter revenue by about 30%. But what really concerned me about JP Morgan was, again, the default and charge-off rate on their loans. Because if we consult JP Morgan's earnings supplement, we can see charge-offs increase from $900 billion in the fourth quarter of 2022 to $2.2 billion in the fourth quarter of 2023. So nearly a tripling in the amount of charge-offs, with the overall rate increasing from 0.33% to 0.68%. And so this is an industry-wide issue, an issue that I've called your attention to over the last couple months, because the American consumer is struggling right now, everyone. And that's ultimately what this data shows. Increasing bad debt and charge-off rates shows that people are running out of money, that they're financially stretched, and that they're having to resort to the worst case scenario, which is not repaying their debt. And that's got to cause you to be concerned about the current state of the economy, because once again, we have all these people people who are thinking that somehow we have miraculously avoided a major recession or economic downturn, yet when you dig into the data, you see that there's concerning warning signs popping up left and right. And if these problems build bigger and bigger as 2024 develops, we're likely to see a big slowdown in consumer spending, one that's already kind of underway. The consumer spending figures are already flat, adjusted for inflation, and I think they might even go down over the next year in nominal terms, which would be a big problem for businesses. With Bank of America reporting in their consumer checkpoint that household spending rose only 0.2% year over year in December, which is minus 3.2% adjusted for inflation. In addition, their winter spending survey suggests that consumers are planning to pull back a bit this year, potentially trimming their spending on meals and other experiences. That's not good, everyone. 0.2% nominal growth in spending year over year, which is negative 3% adjusted for inflation, with surveys saying consumers are going to tighten the belt more in 2024. I mean, this is going to be a big pinch for a lot of businesses around America. A lot of businesses that are already barely hanging on, because we have lots of data coming out that's showing that a lot of small businesses and middle market businesses are losing money and are experiencing declining earnings. And these businesses, they don't get much mainstream reporting because they're not publicly traded companies. However, there's a riptide economy developing under the surface, according to Axios, which is saying that everything is looking great on the surface, but underneath, unseen risks are building, according to a new paper from Marblegate Asset Management, which found that for about 1,200 private companies with revenue between 100 and 750 million, which is known as the middle market in America, that their EBITDA or earnings declined 24% over the last 3 years from 2019 to 2022. Meanwhile, public companies had an 18% increase in earnings. And so we have something actually going on here, folks, which is called the K-shaped recovery, where certain elements of the economy and society are doing better, aka publicly traded companies that are on Wall Street or wealthy people with a lot of capital, they're doing better, they're recovering. But over here, the smaller middle market companies, the smaller businesses, they're doing worse. They're doing much worse. Many regular Americans, they're doing much worse. And the unfortunate thing is that the entities that are doing worse, they don't get any public attention, which is causing so many people to mistakenly believe that this economy is healthy. And ultimately, what I suspect is going to happen is that at some point, when enough of these middle market and small businesses lose money, and when they lose enough money, they're going to pull the ripcord on layoffs, right? You can only lose so much money as a business or see your earnings decline year after year before you say to yourself, okay, now's the time that we need to cut our expenses and try to increase profit to the bottom line. And whenever that breakage happens, right, when these companies just decide at some point it's time to pull the cord, what happens is that the unemployment rate in America, historically, it tends to shoot up very fast, right? Like you look at this historical unemployment rate graph, you can see that, yeah, the unemployment rate will bottom out at 3.4% like it did in the late 60s, or 3.8% like it did in 2000, or 4.5% like it did in 07 before the big bust. But then very quickly, the unemployment rate will double over a year once reality tends to set in. And at that point, things really go in fast motion. And a lot of people are thinking, oh, that's not going to happen now because the unemployment rate is only 3.7%. But if you just look at the history, everyone, you could see it's very common to see a low unemployment rate that hangs around for a while and then bam, a big increase. And I'm not saying this to scare anyone out there, folks. I'm saying this so you guys know what the reality is about what's going on in the economy and about what the history says is likely to happen into the future. And if we do see this big increase in unemployment rate, it's going to cause problems in multiple ways. It's going to compound the issues I'm describing because it's going to lead to more defaults on credit cards for Bank of America and JP Morgan. It's going to lead to lower consumer spending, which is going to lead to businesses laying off more workers, which is going to lead to even more cuts in spending. That's how a recessionary cycle works. And if all of that happens, I have a strong suspicion that both stock prices and home prices will come down by a lot. But amazingly, Wall Street, they're not taking this risk seriously. Like even in the case of Bank of America, we can see their stock price, it only went down a little bit after this bad earnings report. You can see their stock price of $33 a share for Bank of America. It's down 4% over the last 5 days. And if you look over the last 6 months, it's actually up by 11%. And over the last 5 years, it's up by 11%. So Bank of America stock actually hasn't been doing too well over the long term. Really like no growth as of late. However, we're not seeing a crash in Bank of America's stock price. It's kind of hanging in there. Same with JP Morgan, everyone. JP Morgan stock is only down down 2% over the last 5 days since they reported earnings. And actually, over the last 5 years, JP Morgan stock price is up 62%. So JP Morgan, of all the commercial banks, they're kind of the one that Wall Street views as the strongest, right? At least judging by the performance in the stock price. And we can see Citigroup, third largest commercial bank in America, they're actually down 17% over the last 2 years. So varying performance here in the banking sector. And interestingly, Citigroup, they also reported earnings over the last week, and they did not have a good earnings report either. In fact, they announced massive layoffs, everyone. Take a look at this. According to Reuters, Citi is poised to cut 20,000 jobs after it posted a $1.8 billion loss, with their CEO saying that the fourth quarter was very clearly disappointing, with the lender announcing reduction in global workforce from 20,000 through 2026. So that's more bad news for the banking sector, particularly people who are employed in banking. Citigroup laying off that many employees is likely to increase the supply of labor on the market in the banking sector and could cause downward pressure on wages and an increase in unemployment rate for those that work in that industry. And of course, one thing I think is causing lots of people to remain optimistic even in the face of this bad data is the fact that, a lot of people are now banking on the Federal Reserve coming to save the day in 2024 through, interest rate cuts. This has been the big story over the last 1 to 2 months, is that Jerome Powell and the Fed, they've kind of pivoted and they've hinted now that they'll be cutting rates in 2024. In fact, in their latest projections, the Fed thinks that the median interest rate at the end of 2024 is going to be around 4.75, 4.8%, which would be about 75 basis points or 0.75% cut from where interest rates are today. Now, that's not really that much of a cut, everyone. Going from a 5.5% Fed funds rate to a 4.75% Fed funds rate, that's not really going to improve things for many Americans, many borrowers. However, the betting markets think that the Fed's going to actually cut interest rates by much more than that, with the CME Fed Watch tool suggesting that by December 18th, 2024, the median interest rate is actually going to be closer to 3.75%, which would imply 175 basis points of cuts, which would be a much bigger drop. And so lots of people, they're banking on those rate cuts to basically save the day and re-stimulate the consumer spending, take the pressure off the commercial real estate market where the people are defaulting and kind of leading us into this soft landing scenario. But folks, I'm not buying it, because even if those rates do get cut to 3.7% over the next year, that's still going to be really problematic for a lot of borrowers in the economy, because those rates are still going to be much higher than they were prior to the pandemic. In particular, mortgage rates. I suspect by the end of 2024, if these rate cuts come, we're going to see mortgage rates in the mid to high 5% range. And if mortgage rates do follow this anticipated path, yes, they would be lower than they were in 2022 and 2023, but they would still be at the highest level since 2008. Everyone. They'd be at the highest level since 2008, with the house payments that Americans need to make $2,400 a month for the typical home buyer, which again would be actually like one of the highest rates of all time, just excluding 2022 and 2023. And so what I fear is happening is lots of people are thinking Fed rate cuts are going to save the day, going to 4% interest rates, but really, I don't think that's going to help the average American that much, particularly the Americans that are struggling with credit card debt right now, because these credit card interest rates, they're 20 to 30%. So you cut them by a little bit, that's not going to change the game too much for American consumers, particularly after 3+ years of inflation, everyone. It's been this inflation that's created big problems for U.S. consumers, because for multiple years, the costs of goods and services were growing much faster than wages, right? The inflation rate was much higher than the wage rate. And if that happens, the costs go up more than the earnings, it tends to pinch people's budgets and result in, low savings and result in defaulting on credit cards. So I want you folks to take a look at this graph, everyone. We're comparing on this graph the blue line, which is year-over-year weekly wage growth for Americans, to the red line, which is inflation. And what I want to show you folks is what should happen in the economy. What should happen in the economy is what occurred from 2014 to basically the pandemic, where the wage growth was just consistently above the rate of inflation. That's what was happening for 2014 to 2019, 2020. That's good for the US consumer. Then the pandemic hit, and actually there was a short-term bump in wage growth in 2021 during all those labor shortages, which was also, again, good for the average American worker, but then problems started coming. The wage growth started to go down, and it's still been trending down, while the inflation surged. So for 2+ years, the inflation rate year over year was well above wage growth, which really put a lot of Americans behind the 8 ball, which is why, the savings rates are low, and now people are defaulting on their credit cards. And we're in the situation now where, okay, the inflation's 3.3% a year, it's lower. The wage growth is now slightly higher than inflation, but really we're not where we need to be in terms of this wage growth outstripping inflation. What I would want to see is something like 4.5% wage growth, 1 to 2% inflation. If we saw something like that, all right, all of a sudden Americans would have a lot more money to spend, but we're not really seeing a major improvement here, which suggests to me that we're going to continue to see this trend of credit card defaults increase into the future. And this is a trend that you guys need to watch out there, because if my predictions here do come true, higher credit card defaults in the future, that's a canary in the coal mine for broader economic problems that really no one in the mainstream is talking about right now. What shocked me about all these bank earnings reports is that almost none of them actually mentioned the charge-offs and the credit card default rates in the headline or the first couple paragraphs. I mean, I was shocked at that. It's major news that people are defaulting on credit cards now at a higher rate than before the pandemic. And speaking of this reporting, I have some issues with how the Wall Street Journal reported on this Bank of America income collapse. Because this article that I referenced in the beginning, it talks about how it was mainly one-time charges that resulted in this decline in income from Bank of America. Specifically, there was a $1.6 billion charge related to a transition away from LIBOR and a $2.1 billion charge to the FDIC related to the failures of Silicon Valley Bank and Signature Bank. So in total, that was $3.7 billion, and let's just call it one-time charges that Bank of America faced. And if we would have add those one-time charges back to their net income of $3.1 billion for the quarter, we would get $6.8 billion in income, which still would have been a reduction from what it was in the fourth quarter of 2022. So taking those things out, it would have been a 4% decline in income year over year. So okay, yeah, the income would have been a much lower drop. But here's the bigger issue I see. Wall Street Journal goes on to say that, more loans are going bad, but that the charge-off rate is still low by historical measures. So they're reporting on the fact that loans are going bad, but they're saying it's low. And that's not true, everyone. Like, if you look at the historical charge-off rate for Bank of America, their loans going back all the way to 2018, you can see that today's 0.5% charge-off rate, which again is like the bad debt, people not paying the loans, Bank of America writing it off, that's now at the highest rate it's been since the first quarter of the pandemic, and it's now higher than it was before the pandemic. So this is starting to become an elevated rate of bad debt and charge-offs, while the Wall Street Journal called it low. So that's just not factually accurate. It's misrepresenting the reality that many consumers in America and many commercial real estate loan holders are in deep, deep trouble right now, a trend that's likely to get worse. Like, the writing is on the wall for this to get worse. So I hope more of these media entities can do a better job kind of reporting the facts when it comes to things like this and alerting people to the fact that consumer finances are deteriorating, and that's historically a signal that there's going to be problems in the economy. So I hope you guys enjoyed this video. What I encourage you to do is to make sure to hit that subscribe button, turn those notifications on, because I'm going to have even more of these videos, these corporate deep dives. I'm going to have more of them coming for you over the next couple of weeks and months, because I think it's so important for you guys. If you're tracking the economy, you're tracking the stock market, tracking the housing market, you need to know the real truth about what's going on in the economy, especially through these big companies. And I would suggest you guys actually watch a video I just did on MasterCard and their recent report on how much money consumers are spending. It wasn't good. So watch that video on the screen right now.